Hello and welcome back to All Things Money. I'm your host, David Blain, and during today's show, we're talking about a very interesting topic. It started with John Paulson, The Greatest Trade Ever. It's a book out by Gregory Zuckerman, and it talks about how John Paulson and his hedge fund made $15 billion in 2007. And we're dovetailing it into a story that just appeared on Sunday in the New York Times about JPMorgan was accused of breaking its duty to clients. And this goes back to the crisis of 2007, 2008. And I think for years we're going to continue hearing more and more stories about what went on at the depths of this crisis and the negotiations that were taking place. In the book about Paulson, there was a great segment towards the end when Bear Stearns was collapsing, and they were calling Timothy Geithner, who at the time was the New York Fed chairman. He wasn't the Treasury Secretary yet, and they were calling him. They were calling him at home. They were calling his cell phone. They were calling his office, and he wouldn't take their calls. And they had a guy that worked at in the fund that was a cousin of George Bush, and so he called the White House and got put on hold for a long time, and finally somebody came back on the line and said, sorry, the president will not take your call. And so that was the end of, basically the end of Bear Stearns and Lehman Brothers. And it was just fascinating, some of the stories that come out of that crisis. So we can look back now and hopefully learn from it. But this particular story is about JPMorgan and this investment vehicle called Sigma, which was based in London. And they had put $500 million in client assets into Sigma about 2 months earlier. It was a hedge fund. These type of investments for very wealthy investors, the best clients of the bank, they had put it in there. Well, just a year later, this Sigma fund collapsed. And there are new documents revealing that came out that a lot of the investors, which were some pension funds and big institutional investors, filed a lawsuit against JPMorgan, saying that they had been defrauded and so forth. And so some of the documents that became unsealed in this court case showed how high the warnings went up the chain, of course, all the way to the chief executive, Jamie Dimon. But I don't want to focus on, the whole innocent until proven guilty. We don't want to pass judgment on the fine people there at JPMorgan. But what I want to do is use this to illustrate how people really need to stay out of the way of the big Wall Street firms. That they are not your friend. They are not on your side. Of course, I'm partial. We're a fee-only independent investment advisor, which I think is the only type of person you should be receiving financial advice from. It's stories like this that illustrate when you have a big firm, the duty to the clients is a much lower level of duty that the average person probably thinks. And you want to work with an advisor that has a fiduciary duty to you. So anyway, back to the story. So JPMorgan, they had all this money in this thing called Sigma, and it was going down the tubes. Their internal emails and memos and phone calls, and they were talking about how they could protect their investment in the fund. And so they lent money to the fund to try to keep it afloat. They claim it was to preserve their investors, their clients' investments. But at the end of the day, JPMorgan made about $1.9 billion from Sigma's demise. As Sigma's trouble worsened, JPMorgan would lend them money, but they just wouldn't give it to them. They took collateral for these loans, and so they took anything that this Sigma fund had as an asset that was of any reasonable value or that they thought would recover, and they took it as collateral. So when the fund imploded and completely went out of business, JPMorgan had these assets as collateral. And so all the clients' money, which had no collateral, was wiped out, and JPMorgan was left holding some collateral. And as the markets rebounded, the value of these went up, And in the end, JPMorgan made about $1.9 billion on this, according to the lawsuit. And as you read your way through the story and understand what happened, there was this conflict that they knew existed of, well, do we save our clients or do we look out for the interest of the bank? You know, we've got this $8 billion put in loan. And in the end, they looked out for the investment bank. Now, of course, their side of the story is, no, we were just doing it to save our clients. But you've got to look at the end result. And the end result was the clients were wiped out and JPMorgan made almost $2 billion. One of the arguments that JPMorgan is using, and this is very illustrated, there's something in investment banks called Chinese walls, and I don't know where that name came from, but that's what they're called, a Chinese wall, where different parts of the investment bank cannot talk to each other, they cannot relay information. And the reason that is put in place is you don't want, let's say you're about to do you're working with a client to do an IPO, or not an IPO, but a merger. Well, if your brokerage side of the investment bank knows about that merger, and then they may tip off some of their clients to go buy that stock before the merger is announced. And so all the different parts of these big, mega, monster, giant banks, as Clark Howard calls them, they can't talk to each other. And that was put in place to prevent people from profiting from it. Well, now here comes a case where JPMorgan is saying, hey, our different sides of the bank couldn't talk to each other, and so yeah, the CEO knew, but he wasn't allowed to relay that information to different sides of the bank. So the one side of the bank knew that this Sigma fund was going under, but they weren't allowed to tell the other side of the bank to save their clients' money. So it's a very interesting scenario. The rules that come into play to help protect investors actually ended up hurting investors in this case. And so, number one, the rules and regulations out there, they're not always very helpful. And number two, the big point I want to point out is just that these big banks, you've got to know where you stand in your relationship with them, that unless you're dealing with a fiduciary advisor, they are not required to put your interest above their own. In this case is a perfect illustration of that. That they're only required that when they make a recommendation for investment at the time, it be suitable for you. So that's about all the time we have for today. I hope you've enjoyed our discussion about John Paulson, the greatest trade ever. So I hope you'll tune in again next week. Until then, for All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.